Hi everybody, Jeremy Harper here, mortgage broker. Today we're going to talk about security guarantor loans, or also commonly known as family guaranteed loans. And so through this video, we'll unpack the benefits of them, why I love them, I think they're a great product, and what are some of the things we need to look out for. So let's just take a step back here and take an example that we're trying to buy something for $800,000 in New South Wales. Now, if we go down the traditional pathway of saving up to 20% deposit, $160,000 plus the stamp duty. So let's assume this is an investment property, or perhaps it's not your first property. That's an additional $33,000 in stamp duty. So to cover off those two, that's $193,000 in upfront costs. Huge amount of savings to get into that purchase, and that's a barrier for a lot of people. And so some people might think about the option of taking up a 90% loan. We've got some options out there where we can do an LMI waiver, depending on the industry we do work in. But for some people, that's not available. So if we were to take out a 90% loan, because let's say you've only got a 10% deposit in this example, $80,000 plus the stamps, that would mean we'd need to pay mortgage insurance of $18,000 that gets added onto the loan. And every month you then start to pay interest on top of that. So it's a big barrier. There's a couple of things to think about with LMI. If it's an owner-occupier purchase and we're not available to get that LMI waiver, that's non-deductible. Or if it's an investment purchase, that's a borrowing cost that we can amortize over a short term, so 5 years as part of that investment purchase. But still, that is a cost that gets wrapped into the loan, and then you pay interest on top of that total borrowings, on top of what you've drawn down for the purchase. So there's another way. So security guarantor. So let's unpack that. So typically that's using family members' property, real property, Australian property, that could be mum, dad, could even be a sibling, could even extend out to grandparents. That is dependent on the bank's specific credit appetite. And that can be for the purpose of buying a property as an owner-occupier, or also as an investment. I think that's a really, really key component, particularly if you're going down that rent investing strategy. And so a couple of things to be mindful of with the property of the parent is they need to have at least 30% equity at the end transaction. So ideally, the bank wants to see a family property that's put up, or will use the security with either minimal debt or debt-free, which is quite common with some of those older family members that have property. It can be their place of residence, or it can be an investment property. The ideal scenario would be using an investment property as collateral for this transaction, because we'll get to this a bit later, just around the comfort around if there was something to happen with the borrower, what recourse does the bank have on the family property? So if you think about that, if we go down that pathway of an $800,000 purchase, we've retained our savings and we settle on that. So a couple of things to think about. One is we will get better interest rates. We'll get the pricing at 80%, so the banks will take security on the two properties. So we'll end up having a lower cost of funding for the purchase. Instead of, if we went to a straight 90% loan, we'd pay the LMI plus we pay a higher interest rate typically, because banks will price it on LVR. And then secondly, we've got the ability to retain those funds that you would have put towards the purchase. So particularly if you think about a owner-occupier a rent investor strategy, you retain the property, the funds that you've got saved, you put that in the offset account, and then you can deploy that post-settlement. You can start adding value onto that property. So straight away, you can start doing some renovations, uplifting on the property internally, particularly, looking to do some external works, add a new value, a new dwelling, and then getting a new valuation done on that security. And then we can again look at what's the equity available on that property we've just purchased, get a new val. Can we either release the family guarantor at that stage, or can we use that equity to purchase a third property and continue that growth phase on the portfolio? So really, really important, because a lot of people will settle on a property, they'll put all their money into that property, and then they're sort of stuck around. Yes, there may be scope to do some works on the property to either increase the value or even bring it up to scratch to get a higher rental yield for an investor, but they don't have the ability to do that. Then they might go and start taking additional borrowings out at a high interest rate. So again, that impacts the overall cost of that transaction. So what are some of the risks to consider? So the part of the due diligence, particularly if a family or the owner occupiers put up as collateral, we need to be making sure that there's a 2-to-1 ratio of assets in the guarantor's name outside the family home. So if anything does happen with the borrowers and the bank needs to call in that loan, we can draw down some of those liquid assets to pay off that ability, so we're not having to look to sell out that property or the family home, because that's something the banks are not interested in doing. Family tensions can arise, so if you've got multiple siblings, that's just something that needs to be mindful of. If you're doing this for one, perhaps the other siblings want a similar setup, so we just need to be factoring that in. And then also, if they're making sure that if there's something goes wrong with the repayments, if there's a breakdown in the borrowers, because the borrowers will need to be able to demonstrate they can service the total debt. It's not the guarantors. What we're looking at the guarantors is sufficient equity available and the exit strategy for the guarantor, so they're not put at risk. But in terms of the borrowing for the purchase loan and the loan security against the family property, we have to demonstrate to the bank that you can afford the repayments on both. So that doesn't change versus if it was a straight 90% loan secured against just the loan that you're purchasing. So I think this is a great product. Helps people get into the market earlier, helps them take that next step, and also helps them springboard into that next property, maybe building out a portfolio or upgrading that first purchase, because they've started to grow that equity initially versus putting that into LMI, which is a cost that sort of gets waved away, particularly if it's a owner-occupied purchase, and also gets them out of that rental market if they're not renting or have a investment property on the side, and then losing that equity growth in the market. So thanks, guys. If you have any questions, please reach out. Happy to talk about this offline and go through your scenario. Thanks, guys.